Okay. The committee's going to come to order. I want to thank all of you who are present. I'm going to introduce the second panel of witnesses and begin with Dr. Mark Cooper. Thank you for being here. Dr. Cooper is a senior fellow for economic analysis at the Institute for Energy and Environment at Vermont Law School. He's the author of dozens of articles and 6 books on energy, technology, and telecommunications. He's provided expert testimony in over 250 cases for public interest clients, including state attorneys general and citizen interveners before state and federal agencies and courts. Dr. Cooper received his Ph.D. from Yale University. Mr. Henry Sokolowski, welcome. He's Executive Director of the Non-Proliferation Policy Education Center from 1989 to 1993. Mr. Sokolowski served in the Bush administration in the Office of the Secretary for Defense. Previously, he served as Senior Military Legislative Aide to Senator Dan Quayle and as Special Assistant on Nuclear Energy Matters to Senator Gordon Humphrey. He's also had an association with the Heritage Foundation and the Hoover Institution. Mr. Sokolowski is author and editor of several books and numerous papers. Mr. Richard Caperton, thank you for being here, is Energy Policy Analyst at the Center for American Progress, where he's concentrated on the analysis of financing mechanism and incentive structures intended to encourage clean energy technology. Previously, he's worked at the National Rural Electric Cooperative Association. He's a graduate of Pomona College and Georgetown University's McDonough School of Business. Mr. Michael Scott, thank you for being here. He's Managing Director at the investment bank Miller, Buckfire, and heads its United States Government Advisory Practice. Previously, Mr. Scott was Senior Advisor to Chairman Christopher Cox. Before that, he was Managing Director and Head of the U.S. Government entities at Bank of America Securities, where he advised companies on federal loan guarantees to build a proposed Alaska natural gas pipeline, as well as those associated with advanced energy facilities, including the Energy Policy Act of 2005. Before that, Mr. Scott served for 5 years at the U.S. Department of Treasury as Senior Advisor. There he was Principal Architect of the Federal Credit Policy. He negotiated and structured programs that provided federal credit to a wide range of industries, including airlines, banks, rural telecommunications, and energy companies. He was also responsible for Treasury's role on the Air Transportation Stabilization Board, where he structured and negotiated loan guarantees supporting the $429 million unsecured loan to America West Airlines. And finally, Mr. Christopher Guth is Vice President for Policy at the United States Chamber of Commerce Institute for 21st Century Energy. Thank you for being here. Previously, Mr. Guth served as the Deputy Assistant Secretary for Nuclear Energy at the U.S. Department of Energy excuse me, and represented the Bush administration during the drafting of the Energy Policy Act of 2005. Before that, he was Legislative Director for former Congressman Bob Barr. He is a graduate of Syracuse University School of Law and University of California at Santa Barbara. Again, I want to thank each and every one of the witnesses for being here. This is indeed a distinguished panel, as was our previous panel. I want to thank you and also tell you that it is the policy of our Committee on Oversight and Government Reform to swear in all witnesses before they testify. I would ask that you rise. Please raise your right hand. Do you solemnly swear to tell the truth, the whole truth, and nothing but the truth? I do. Thank you. Let the record reflect that each of the witnesses answered in the affirmative. I would ask that each witness give a brief summary of your testimony. Please try to keep the summary under 5 minutes in duration. Your entire written statement will be included in the record of the hearing. Dr. Cooper, you're our first witness on the panel. I would ask that you proceed.
Thank you, Mr. Chairman, members of the committee. The fundamental economics of nuclear power should determine whether a new generation of reactors is constructed in the United States. In my testimony, I show the basic supply and demand fundamentals of new nuclear reactor economics that have led Wall Street to refuse to put up the funds to finance new reactors, and why policymakers in Washington should not force taxpayers to do what the capital markets will not. I answer 4 questions posed to me by the committee. First, cost overruns in the construction of nuclear power plants are not a thing of the past. They are a recurring present-day problem. Cost escalation and overruns afflicted the industry during the 1970s and 80s, when the final reactors built were 7 times as expensive as the initial cost estimates for that round of construction. The escalation in projected costs since the beginning of the so-called nuclear renaissance has rivaled that historical experience. In less than a decade, the projected costs have more than quadrupled. The causes of this escalation are well known. Reactor design is complex, site-specific, and non-standardized. In extremely large, complex mega-projects that are dependent upon sequential and complementary activities, delays tend to escalate into interruptions. These one-of-a-kind specialized projects have few suppliers, so any interruption or delay in delivery cannot be easily accommodated, and any increase in demand or disruption in supply sends the cost of components skyrocketing. Material costs have been rising and skilled labor is in short supply. The energy-intensive materials and construction processes that are involved in nuclear reactors entail processes that are likely to be deeply affected by any carbon policy, so the cost escalation will be built in. The current costs of nuclear reactors are extremely expensive, uneconomic, and those costs are likely to escalate, not decline, if these reactors are ever built. Second, we do not currently have such demand for electric power plants that we need to rush into the construction of multiple nuclear reactors. We have time to experiment and to see what does and doesn't work before we proceed. Whether or not climate policy is enacted, efficiency and several widely available renewables are substantially less expensive than nuclear reactors. They can push out any need for these facilities for decades. So the rational approach is to build the low-cost, low-hanging fruit available and take the time to develop alternative low-cost options. Third, Wall Street won't invest in nuclear power plants for very good reasons. In addition to the supply and demand factors I have already mentioned, these plants are subject to dozens of risks: technology risk, policy risk, regulatory risk, execution risk, marketplace risk, which make them a bad investment. A combination of these risks are what created the financial disaster in the last round of nuclear construction. Given these risks, Moody's is right to have declared investments in these projects a bet-the-farm decision, and other analysts want a return on investment, a risk premium, 2 or 3 times as large as the normal premium. That is why Wall Street will not invest in these projects. Finally, increased loan guarantees for nuclear power plants misdirect resources that could be better used for energy efficiency and renewables. Loan guarantees induce utilities to develop the wrong resources. They choose high-cost, high-risk, capital-intensive projects that pump up their rate base. That's how they make money. And leave behind the more economic, less costly facilities. The result is a dramatic increase in the consumer's bill. You heard a suggestion that Georgia Power Southern Company estimates a $15 to $20 million a year savings from the loan guarantee. The excess cost of those facilities is between $500 million and $1 billion a year. It's a bad deal for the ratepayer. The rejection of financial markets that has afflicted nuclear reactors is not an example of market failure. It is, in fact, a market success, an instance, and frankly there have been too few lately, where the marketplace has properly evaluated risk and refuses to put private capital on the table. If Congress were to override that decision, ignore the indication of Wall Street, it would place ratepayers and taxpayers at severe risk that I think would mount in the end to trillions, not billions or even hundred billions of dollars. Thank you.
I want to make sure that for the record that I have the pronunciation of your name. The copy that I have in front of me says Sokolowski. Now, your name card says Sokolsky. Would you help me out here?
I kind of prefer the latter.
Okay, well, that's what it is. It's
I've gotten used to
Sokolsky. Well, you know, where I'm from in Cleveland, Sokolowski's a well-known name, and the copy here did say Sokolowski, but it's Mr. Sokolsky and Vitam Vas. Welcome.
Okay. I don't make helicopters either.
Welcome.
Right. Thank you, Mr. Chairman and members of the committee, for allowing me to testify before you today on whether or not creating additional federal loan guarantees for new civilian nuclear energy plants is advisable. My short answer is it's a bad idea. This is based on...
Bring that mic a little closer, please.
Even closer? Okay. There we go. This is based on the findings of a 2-year study my center just completed on nuclear economics, the key findings of which I'm releasing today. I'd ask the committee if I could present this as an exhibit along with 2 other short op-eds.
So ordered, without objection.
In general, my views are like that of many of the panelists you've already heard. I think the key problem new nuclear power plants have is that to become economically competitive, they have to reduce their capital construction costs considerably. I think piling on more government financial incentives beyond those you have already voted for and approved to promote commercial deployment of nuclear power is only likely to reduce market pressures on the industry to meet this critical goal of reducing capital costs. This then brings me to the committee's 4 questions. Are cost overruns in the construction of nuclear power plants a thing of the past? I think if we understand what's happening in Finland, France, Canada, and the U.S., the short answer is no. In addition to the Finnish and American cases you've already heard, we have the French case of EDF struggling to keep construction of a similar plant to that being made in Finland on schedule, and in France, the project's now running more than 20% over budget and at least 2 years behind schedule. In Canada, the government of Ontario put its power plans on the table to build 2 large reactors and decided to put them on hold after receiving a $26 billion bid that was nearly 4 times higher than the $7 billion the government originally set aside for the project only 2 years before. As you've heard, in the U.S., projects at an advanced stage of planning have seen their cost projections soar 4-fold in less than a decade and are still rising. Why won't Wall Street invest in nuclear power plants, and why does Moody's call them bet the farm investment? 3 reasons. First, projections of new nuclear power plant construction costs are far higher today than several non-nuclear alternatives, while the long-term requirements for ever larger numbers of baseload generators, nuclear or non-nuclear, could easily decline as a result of energy technology innovations. Betting nuclear power will make money through 2080, when nuclear power plants clearly cost far more to build now and take far longer to construct than cheaper alternatives, is too large of a gamble for private investors. Like U.S. spending on canals in the early 1800s, which was undercut by the advent of steam locomotives, the risk of investing in expensive nuclear plants is that energy innovations in the storage, generation, distribution, or use of electricity could easily wipe out the value of whatever commercial nuclear investments are made. You've already heard about the history and how unkind it's been to nuclear power projects in the past. I think this is the reason why the nuclear industry is seeking more federal loan guarantees. Finally, the value of federal loan guarantees is so uncertain, and the ability of the utilities to cover their risks with their own capital so low that even with loan guarantees, private investors are leery. I would like to associate myself with the recommendations already made that you really need to make sure that Congress demands that DOE supply Congress with answers to the questions about the cost of these loan subsidy fees. That you need to get clear. Without that, the private industry is going to be very leery about getting involved, even with loan guarantees. You asked, do increased loan guarantees for nuclear power plants misdirect resources that could be better used for energy efficiency and renewable power projects? I will keep my comments short. The short answer is yes. Experience with syn-fuel, breeder reactors, ethanol mandates, and the like should teach us all enough not to repeat. Finally, do increased loan guarantees for nuclear power plants misdirect United States financial resources for the benefit of other countries? Here, The short answer, again, is yes. Areva and EDF, who design and build the evolutionary power reactors, plan for the ES, are key beneficiaries along with Hitachi and Toshiba, the Japanese firms who have teamed up with Westinghouse and General Electric and who now have a controlling or a significant ownership portion of these companies. Urenco, a European consortium that is building an enrichment plant in New Mexico, also stands to benefit, as does Areva, which is building enrichment plants in Idaho. Almost all of the manufacturing jobs associated with these plants' construction will either be done abroad or in factories owned by these firms. Bottom line, if renewable natural gas and carbon prices were all clearly rising, and the technologies for electricity storage, distribution were static, the case for government intervention in promoting commercial nuclear power, although wrong in principle and practice, would at least be stronger. Yet, just the opposite seems to be the case. I believe getting into this further than we already have is risky business, and pure risk at that. I think the losses are quite possible, and the gains simply are not there. Thank you very much.
Thank you very much, Mr. Sokolsky. Mr. Caperton, you may proceed.
Thank you, Mr. Chairman.
And keep
Ranking
that
Member
mic
Jordan.
close so we can hear you. Thanks.
Sure. Members of the committee, thank you for inviting me to testify before you this afternoon. My name is Richard Caperton. I'm a policy analyst on the energy team at the Center for American Progress, a think tank here in Washington, D.C. As you know, nuclear power currently generates about 1/5 of American electricity. Nuclear power is a low-carbon, baseload power source that will continue to play an important role in America's clean energy future. It's vitally important that we explore all potential energy sources that reduce our carbon emissions, but this should not force taxpayers to bear inordinate amounts of risk. The President has proposed incentivizing new nuclear construction by issuing $54 billion in loan guarantees. The terms of these guarantees must include adequate protections for taxpayers. Most important, the credit subsidy fee must be properly calculated. In my comments today, I will describe what the credit subsidy fee is, how it's calculated, and what an appropriate fee might be. First slide, please. When the government issues a loan guarantee, they're committing to use taxpayer money to pay back the loan if the borrower defaults. The government must account for the increased risk it now bears, which it does by calculating the credit subsidy cost. In the Nuclear Loan Guarantee Program, the credit subsidy cost is paid by the borrower in the form of a credit subsidy fee. If the fee charged is too low, it will increase the risk to taxpayers. At the same time, if the fee charge is too high, it will unnecessarily decrease the number of reactors financed. The credit subsidy cost is calculated by a proprietary model at the Office of Management and Budget. And although the actual calculation is highly technical, the basis for the calculation is straightforward. Essentially, the credit subsidy cost is the present value of the expected payouts that the government will have to make on the loan if the utility should default. Next slide, please. There are 5 basic steps in calculating the credit subsidy fee. First, determine the likelihood that the builder of the reactor won't be able to pay back the loan, the default rate. Second, determine the percentage of the total reactor costs that will be covered by the loan guarantee. And in the nuclear program, the guarantee can cover up to 80% of the total cost of the project. Third, determine the amount of the total costs that will be recovered in the event that the borrower defaults and the reactor is sold in liquidation, the recovery rate. The first 3 steps give a total payout that the U.S. government will have to make. Spread these payouts over the lifetime of the loan based on when expected defaults will occur. And finally, discount the payouts in future years to determine a present value of the total payouts. This is the credit subsidy fee. Each of these steps requires an input that can vary widely based on technical details, which makes precise calculations very difficult. Estimates of what this fee should be run the gamut from 1% or less to 30% or more of the total loan guarantee. Faced with these widely divergent estimates, I've done some simple calculations of the credit subsidy cost given certain inputs. The 2 most important, of course, every project is different and should be evaluated independently. But widely publicized data from CBO, GAO, and Standard & Poor's indicates that the expected rate for generic new nuclear reactors. Simple calculations indicate that the credit subsidy fee on a nuclear loan guarantee program that has the predicted characteristics, that is 50% default and recovery rates, should be about 10% of the total value of the guaranteed loan. The appropriate fee goes up as the expected default rate goes up and as the recovery rate goes down. This table shows what the credit subsidy fee should be given any combination of expected default and recovery rates. And to put this in perspective, Each 1% of the entire $54 billion in loan guarantees that the President has proposed represents $540 million. That is, if DOE undercharges loan guarantee recipients by just 1%, the President's proposal will cost taxpayers $500 million. It's impossible to say what the credit subsidy fee on a specific loan guarantee should be without looking at details of specific nuclear projects. The administration must keep in mind, however, that credit subsidy fees should be set at a rate that protects taxpayers, not at an artificially low rate as a handout to private businesses. DOE will only be able to protect taxpayers from bearing the risk of new nuclear reactors if it charges an accurate credit subsidy fee. Thank you.
Thank you for your testimony, Mr. Scott. Chairman Kucinich, Ranking Member Jordan, members of the committee, thank you for the opportunity to testify here today. My name is Michael Scott, and I head the U.S. government investment banking business at Miller Buckfire. In creating Title 17, Congress recognized that there was a private market failure to finance new clean energy technologies that reduce greenhouse gas emissions, and that this market failure encompassed a broad range of technologies. Congress also recognized that the importance of getting these clean technologies constructed and into operation. However, given the cost of the various eligible technologies, the U.S. government was unlikely to have the budget dollars necessary to appropriate to Title 17 projects in amounts sufficient to achieve the purposes of the program. So Congress provided a unique path among federal credit programs to finance enough projects to get a technology into general use, with the private sector paying the full cost of the guarantees. Prior to the Federal Credit Reform Act, the costs of federal credit programs were only evaluated and appropriated at the time of default. This approach did not provide legislators or policymakers with the true budget impact of a federal credit program, and was inconsistent with the budgeting process in the non-credit spending programs of the U.S. government. The Federal Credit Reform Act is designed to calculate the net present value of the long-term cost to the U.S. government of any federal credit program. Properly and faithfully implemented, the Federal Credit Reform Act considers all of the cash flows over the entire lifetime of the loan, including defaults, fees, recoveries, as well as contractual and structural protections. With potential tenors of 30 years, this entire lifetime of the loan analysis is very important and substantially different from the scoring of non-credit spending programs of the U.S. government that do not analyze, measure, or otherwise calculate the cost beyond the 10-year budget window. Each project is subjected to extensive due diligence and statutory and rule requirements that protect the taxpayer and fully price the risk that would be assumed in providing a loan guarantee. The President and Congress have a very powerful policy tool in Title 17 that is unique and important in the current economic environment, especially with the U.S. government facing the stresses and difficult choices involved with our significant budget deficits. Title 17 can drive economic growth through the development of clean energy infrastructure projects that are built and fully paid for by the private sector, provide significant short-term and long-term construction and manufacturing jobs, provide long-term operating jobs, promote the development of new U.S.-based manufacturing, particularly significant in the case of manufacturing that will develop from a robust new nuclear build, develop environmentally clean and secure domestic energy supply capacity, particularly in the case of carbon-free baseload generation from new nuclear, correct the private market failure to finance clean and innovative energy technologies, and finally, provide well-qualified project sponsors with confidence that credible projects can receive a federal loan guarantee, which is an important signal for private sector project sponsors to pursue these substantial investments because of the upfront cost that they bear before any application and significantly before any closing on a federal loan guarantee. Significantly, the President does not need new legislative authority or new appropriations to make Title 17 work, as Title 17 provides for the credit subsidy and the administrative costs to be fully paid for by the borrower and substitutes the borrower payments for the appropriations. This means that the federal budget is not affected by the issuance of the loan guarantees under Section 1703, and that the level of risk assumed by the U.S. government is fully compensated for as measured by the Federal Credit Reform Act. The calculation for this risk is completed in the same manner as if this was a traditional federal credit program where the U.S. government paid the credit subsidy costs. In summary, Title 17 provides a means to achieve the priorities and policies of the President and Congress pertaining to jobs, the economy, clean and secure domestic energy capacity, and the environment. It does so through a clean energy infrastructure build that is fully funded by the private sector. This build will also be the engine of growth in the investments that develop our domestic supply chain manufacturing base in supporting industries such as iron and steel. The key to all of this is operationalizing Title 17. The President and his administration can accomplish these critical objectives by removing the current improper rule-based impediments, elimination of the arbitrary maximum loan guarantee, authority levels, and calculating the credit subsidy in a manner that is faithful to the statute. I am pleased to answer any questions that you may have. Thank you. Thank you very much, Mr. Scott. Mr. Guth, please proceed.
Thank you, Chairman Kucinich, Ranking Member Jordan, and thank you for the opportunity to contribute to this discussion today. I serve as the Vice President for Policy and the Managing Director at the Institute for 21st Century Energy, an affiliate of the U.S. Chamber of Commerce. The Chamber is the world's largest business federation, representing the interests of more than 3 million businesses and organizations of every size, sector, and region. The underlying issue presented at this hearing is a valid one. Is the federal government properly balancing the protection of the American taxpayers with its joint responsibility to improve our nation's energy security? I think it's important to remember how this program came to exist over the past 4 years. The idea of a loan guarantee program originated in Congress with the intent to accelerate private investment into new and clean energy technologies. It was the unanimous, bipartisan, and bicameral voice of the 4 conference managers that ensured inclusion of the loan guarantee program in EPACT, or the Energy Policy Act 2005, fully acknowledging the importance of this program to the building of new nuclear facilities. This program initially elicited skepticism from senior leaders of the Bush administration. Frankly, many had doubts about whether the government possessed the necessary experts or understanding of capital markets to sufficiently protect the taxpayer. However, building on the Federal Credit Reform Act and OMB guidance, DOE sought to create a program centered around a rigorous review of proposed projects that would utilize every possible resource to minimize taxpayer exposure. DOE spent the next 3 years standing up the Loan Guarantee Office, staffing it with esteemed subject matter experts who had spent entire careers in project finance, risk mitigation, and lending. They utilized the expertise of credit agencies, commercial lenders, engineering contractors, and legal consultants, to name a few, ultimately producing the final rule this past December. Spanning 2 administrations, DOE, the Department of Treasury, and OMB all exerted significant input and oversight into the evolution of the final rule. Additionally, Congress has played, as this hearing demonstrates, and continues to play, a significant role by way of authorization and oversight. In fact, many senior congressional leaders have taken issue with the amount of time it has taken to begin issuing guarantees, which I think is a testament to the careful and deliberate nature underpinning the implementation of this program. In measuring taxpayer risk, I think it is very important to acknowledge and understand the magnitude of risk a company accepts when it decides to build a new reactor. Even with a federal guarantee, each company understands that if a new project were to actually default, it would likely be the demise of that business. When a company does make a decision to build a new reactor, it will not be until it has completed an exhaustive review of its own risk, which by rule is greater than the government's, and has determined that risk is sufficiently minimized to effectively, as has been stated before, bet the company on the project. The federal government has a greater responsibility to Americans than just to minimize their exposure to risk. It must also craft and implement broader policies that further the taxpayer's interests while also mitigating risk. Energy touches on every single business and household every day, and fostering the deployment of clean energy technologies is a major component of fulfilling the government's obligation, and the DOE loan guarantees are an integral tool in doing this. To date, the Nuclear Regulatory Commission has received a net of 26 license applications to build new nuclear units. While the first license is not expected to be issued until next year, industry has already invested in excess of $5 billion in preparation of building new reactors and generated more than 15,000 new jobs. If all 26 of these proposed reactors are built, we estimate that as many as 240,000 direct and indirect jobs will be created by 2030, jobs paying about 36% above the local average. Nuclear plants each purchase $430 million in goods and services from the surrounding community and provide $40 million in salaries and nearly $100 million in tax revenue.